Hi guys, how's it going? It's Alberto checking and coming to my YouTube channel. I'm one of the people that dream of having a property of their own one day. And you know, when we graduate varsity, we are always told by parents that you need to first invest in property because it's an appreciating asset. But the question is, what do you do when you do not afford it as yet? And the answer to that is that you invest in real estate investment trust, also known as REITs. So in this video, we're going to discuss what REITs are, look at REITs listed on the JSE that you can buy for 20 rands or even less, compare them to physical property, and also look at the factors you can consider when you are investing in REITs. And guys, please note that none of my videos constitute as financial advice. I am not a financial advisor. Now, to define REITs, these are companies that own income-producing properties. The highlight there is income-producing properties. REITs own many types of commercial properties. For example, your malls, shopping centers, hotels, warehouses, apartment studios, and even hospitals. So REITs are traded on the stock market. You can buy shares in them like you buy shares in any company, like buying shares in ShopRite. And this entitles you to ownership benefits. And with REITs, the most common benefit is dividend-based income. And REITs are known for their high income. So if you are looking to invest for income, then you might consider investing in REITs. By South African law, REITs are required to pay at least 25% of their profits to shareholders, and that is you and I. That's why they pay high dividends. And they mostly afford to pay those dividends because they have tenants that they constantly receive cash from. So REITs have a strong cash flow. And REITs are reliable where income is concerned because their dividends are sustainable and reliable. I mean, they're required by law to pay those dividends. So you'll hardly get stories with REITs, especially good REITs. So you are guaranteed income from an investment that costed you 15 rands per share, because most of them trade at a price way less than that. I don't know of any REIT that costs more than 60 rands. I don't know of any. If there is, I just don't know of any. But one thing I know for sure is that most of them are going for like 12 rands, 15 rands, 20 something rands. So they are way affordable. And in as much as dividends from REITs are attractive, if it looks too good to be true, then it's probably too good to be true. And this is true for investing in general, for dividend investing in general. For example, if now a company's dividend yield is 20%, that is too good to be true. And then we then start to ask ourselves questions as to whether they even afford to pay those dividends. Are those dividends going to be sustainable? Because one thing about investing for dividends is that we are looking for sustainable dividends, right? It's a thing of, now when I retire at 60, will this company still be around? Will it still be paying dividends like it is paying now? So it's very much important to consider that sustainability element when you invest for dividends, and in REITs more especially. And also because they're required by law to pay a big chunk of their profits as dividends. So you have to be very much careful when you invest in REITs, because if now it comes with a high dividend yield, you might be happy now, but you might not be happy with that REIT when it's 20 years or 40 years later, and you just want to, rest, don't want to work anymore, and want to rely on your dividends. So don't just invest for dividends without considering other factors. And like I say, if you look at it and it looks too good to be true, then it's probably too good to be true. And the good thing about REITs is that they give exposure to the property market. So you might not need to go purchase physical property because you get that exposure when you are investing in REITs. And it is through REITs that you get to invest in property without worrying about having a crazy amount of money that you typically need when you want to purchase a physical property. So you don't need a lot of money to invest in REITs because they are affordable. So now let's look at REITs that we have on the JSE. So I have this app called Simply Wall Street. This is where I see all these companies, everything about these companies, what they do, what the share price is, everything, dividends, everything actually. So I'm going to go to Discover. This is where we are going to search these REITs and see all of them. So we're going to go to browse all stock and then click on that industry and go to real estate, because this is a real estate investment trust. So on here you see that they show us all these companies that are listed on the JSE, the REITs listed on the JSE. There's quite a lot that you can just come on here and choose which one you want to invest in. And then if we scroll to the right, we are able to see the last price, that is their share price, and you see most of them are 13 rands, 14 rands, and 11 rands. There's only two that are trading above 40 rands actually, but otherwise most of them are that cheap. Like I have mentioned, they're the most cheapest. So scrolling to the right, we're going to see the dividend yield, and most of them have a dividend yield of 8%, like above 7%. So you see there we have your 8%, 7%, 10%. This is to actually prove that REITs pay a lot in dividends because the dividend yield is that high. So the stock market has actually given us a chance to invest in property without incurring a whole lot of costs, because one thing about buying physical property, guys, it comes with a whole lot of costs, and these include bond registration and transfer costs, repairs and maintenance, utilities, rates and levies, and insurance. So why investing in physical property is way too capital intensive, because it requires a whole lot of money. But the good thing with REITs is that you don't incur any of these costs, because these REITs are traded on the stock market, and what you just do is buy shares in them. And those REITs are the ones who are going to stress about all of this cost, all of this headache that come with owning physical property. So you are not going to exhaust your energy on any of that. And another nightmare is that people who own physical property have to deal with tenants, and it seems like that is a headache for most of them. But when you invest in REITs, you don't care about dealing with a difficult tenant. That REIT, either storage, redefine, Emira, they are the ones to deal with their people. And then you, as an investor in REITs, what you care about is your dividends. So you were just chilling, and then they worry about sorting out their issues with their tenants or their repairs and maintenance and whatever. They go, they collect their money, and then they come and share their money with you without breaking any sweat. So investing in REITs actually gives you the privilege of investing in property without investing in property, if you get what I mean. But now you must be mindful of the type of REIT you are going to invest in. For example, we have hotel REITs, and such REITs are actually very sensitive to economical indicators. For example, if now COVID was to hit again, people are no longer traveling, what is going to happen to that revenue that they were generating? That REIT, so they are most likely to suffer losses, and you as an investor, you're also going to suffer losses because you invested in this REIT because you wanted income, and now all of a sudden this REIT cannot give you what you have the right to, because they are not generating enough revenue and there's no profit, so they won't be declaring any dividends because they won't be making any money. So when you invest in REITs, you have to be very strategic about the types of REITs that you invest in. This should be REITs that you know that regardless of what happens, I still stand a good chance of receiving my dividends from this company, because they are positioned well that no matter the state of the economy, they are able to generate income. So a good type of REIT would be retail REIT, because if you think about it, this is a REIT that owns malls, and in those malls we have shops like your ShopRite, your Pick and Pay, your Checkers, and we need to go and buy from those shops. We cannot live without food. So that REIT is actually benefiting from a fact that people need the products that its tenants are providing. So when you invest in this kind of REIT, you know that even if it's COVID, we are locked inside. One day they'll open because we have to go and buy food. And when we buy food, for example, Checkers is generating money, and it will be able to pay that REIT because they are a tenant. They need to pay their rent expense. So be very mindful on the type of REIT that you're going to pick. It should be that this is a REIT that can weather any economical storm, and you as an investor, you're still going to be safe regardless of whether it's COVID, it's, recession, depression, whatever, that I'm going to get my dividends, because they're all about dividends, and we invest in them because we want dividends. And when you invest in REITs, you will be investing in a whole different asset class that is very much reserved. Like property is a good investment, either physically or not, is a good investment. It is not going anywhere. we must live somewhere. The shops that we buy from, they must be situated somewhere. So even after 100 years, property is still going to be here. So it's a good asset class to diversify into. So when you buy REITs, you're actually diversifying your portfolio in that regard. And the good thing with buying REITs instead of physical property is that REITs are way too liquid. There's so much liquidity in the stock market in general because you can buy shares now and sell them the next minute. But with physical property, you cannot do that. You have to list the property and it might take a year before you sell that property. And the problem also is that somebody might come and be like, oh no, give me this property at 10% less. Like they might negotiate a price that is a bit below what you have listed your property at. But with REITs, if now my capital gains on this REIT are 10% and I have 10,000 invested and now my portfolio is on 11,000, I'm going to sell my shares at 11,000 without anyone trying to negotiate with me that, oh no, Lerato, hold on, give me the 10.5. That's not the case with REITs. If you are up 20% and there is 2,000 added to maybe your 15,000, you are going to get to 17,000 with no negotiations with anyone. So now to look at factors to consider when buying REITs, the number one thing is that you need to consider how long they have been in the game, like they've been listed or like they've been established. Because just like with any company on the stock market, they must have a proven track record that they've been around for the longest time and they've been paying dividends and they have had great capital growth. So with the REITs, because we are investing in them for income and we are hoping that when you retire, when you now want to retire at 40 or 60, they still need to be giving you dividends. They need to prove to you that they have been paying dividends for the past 20 years and they have been consistent with that. That is why it's very much important that you get to consider for how long they have been in the game. And in as much as history does not tell us what's going to happen in the future, it is a good indicator, right? Because if now, for example, there is this REIT that owns malls, the malls have been around for 20 years, they're not going anywhere, those malls, they will always be there. So we're just hoping that that REIT is going to continue managing the property well, managing their finances well, and they will not lose those malls. You get my point? So it's very much important that you get the history of that REIT that you're investing in. And the second thing to consider is the net operating income. This is the profit. Remember, dividends are paid from profits, right? This company must go and sell their property to whoever, and that person must pay them. And when they pay them, that now is being turned to profits. So REITs have to be profitable. If they are not profitable, the problem is that one day you'll wake up and you're not going to get paid dividends because dividends are paid from profits. So if this REIT is not profitable, how are you going to get your dividends? And another thing to consider is that you should not just invest with that arrogance to say, as long as I'm getting paid. Okay, you might be getting paid, but the question is, does this REIT afford to pay you dividends? Because the problem is that if they do not afford to pay dividends, if they are not profitable today and they pay dividends today, it's a question of where do they get money to pay those dividends? You could find that they're taking debt to pay you dividends to make you happy, but then the business, the company is not doing well, and the risk is that they might go insolvent one day. They might be delisted. Your shares will be losing value and you're going to actually realize those losses because when they now say they are delisting, you're going to want to sell your shares and you'll sell them at a loss. That's the problem. And another link there is that when a company is not profitable, the share price tends to reflect that. It's going to go down. So a share price is actually a reflection of how good the company is doing financially. So if you are just happy to receive your dividends, you don't care how the company is doing, one day it's going to catch up with you. And it's going to be very sad that you're going to stay invested in a company that you are okay with receiving dividends, but then the share price continues going down because they are not profitable. So you need to consider the company's profitability to see if it's even increasing. They can be, but then are they increasing their profits? And that is very important, honestly, because there must be an increase. And the last one to consider is the occupancy rate. This is way too important because this determines the profit. You know, there's a REIT that has apartment buildings, right? But nobody's staying there. How are they going to make money? And how are you going to get paid, right? So all of these things are linked, and you cannot look at one in isolation. You might look at their financials and say, oh no, like they're profitable. But now when you check their occupancy rate, it's declining. You know, it cannot be, because if now it's declining, it means that that REIT is no longer in demand, and one day it's going to go out of business. So the occupancy rate must be reasonable. It cannot be at like 60%, you know, like let it be maybe at like 90, somewhere there, whatever that is that you are comfortable with, and also considering the profit that they're generating from that occupancy rate. The last thing that is a disadvantage about REITs is that they are taxed, and they can be taxed heavily, right? They are not subject to your dividends tax, which is fixed at 20%. They are taxed according to the income tax table, and there are different percentages there. If one day you wake up and then you receive so much dividend income from a REIT, you're then going to move from this tax bracket to the next tax bracket. So you might end up paying more in taxes because it is taxed according to the income tax tables, not the dividend tax. But the good thing is that we have tax-free savings account. In as much as you will not find individual REITs in a tax-free savings account, you will find ETFs that are tracking these REITs, and probably like the top REITs on the JSE. So you can buy that ETF that is under the tax-free savings account to save on your taxes. So you have a choice to go and buy this REITs individually, or invest in an ETF that tracks these REITs. There are, I know of Satrix Property, there is One Invest SA Property. I don't know if there are others, I only know those two. So you can just go and check them out if you don't want to go and buy an individual REIT. And also, you know, ETF investing, it has so many advantages, you know, so you are now going to be investing in a whole lot of REITs at just buying that one ETF, than just deciding that, oh, I'm going to add all of them in my portfolio. It's really not a good move. You can't do that. And maybe then in my next video, I need to look at that as a disadvantage, because it can have a very negative impact to your portfolio. So to avoid having so many REITs in your portfolio, you can go and buy an ETF that tracks this REIT and have it in your tax-free savings account to save on taxes. And the mistake that I see people making is that they think it doesn't matter to have these ETFs in the TFSA, because they're like, oh no, it's just 20%, you know, and simply because you're receiving 10 rands now as dividends, you think, they're only taking 2 rands. But imagine when you now have a whole lot of money invested in that ETF, SARS is going to charge you, you know. So we should not look at it from a specific amount. It should be a thing of, I don't want to pay taxes at all. I don't want SARS to touch my money. And if you can invest in the TFSA and legally avoid tax, then why not do it? You know, so if you have those ETFs in the red app, not the purple one, you might consider moving them, you know. Or if you are not yet investing in ETFs, then consider having them in the TFSA, because you have to save on taxes. Those 2 rands that you think they're not making any difference, they're going to make a very huge difference one day. So guys, that's it on to this video. I hope that it was informative, and yeah, I will see you in my next video next week. Bye.